In this session, we shall look at different elements of financial statements as defined by the conceptual framework. So what we're going to do in this session is first of all define what we mean by these 5 different elements of financial statements. We'll also look at the conditions necessary for the elements to be recognized or recorded in financial statements, and lastly we'll explain the different ways that the elements could be valued or measured. When we consider different types of financial transaction, we can categorize them by their effects on 5 different elements. The first 2 relate to performance and are income and expenses. The remaining 3 relate to the position of the organization and are assets, liabilities and capital. And in this video we're going to look at the definition of each of these different types of element. So let's start by looking at assets. Now, an asset is a resource controlled by an entity as a result of past events and from which future economic benefits are expected to flow to the entity. So let's try and look at this and work out what it actually means. Well, first of all, when we refer to an entity, that might be a company, it might be a sole trader, a partnership, or another kind of organization. First of all, we can see that an asset is a resource controlled by an entity. So the entity itself can direct the way it is used. So that's what we mean by control. Then we say that an asset must be as a result of past events. So for example, if I expect to acquire an asset next year, well, that might not be as a result of past events, it might be as a result of what I expect to happen over the coming year. So we would not treat that as an asset. Finally, we talk about future economic benefits. And when we're talking about these, we're saying that that item or that transaction has the potential to contribute directly or indirectly to the company's cash flow. So we think that it'll either generate or save some cash, or it's already in the form of cash. Now, a liability is defined as a present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. So again, let's look at some of these terms and try and work out what this definition means. Well, first of all, it's talking about a present obligation. Now, this is a duty or a responsibility to act or perform in a certain way. For instance, I am now obliged to pay over a sum of money at the end of the month to a supplier. Secondly, this present obligation has to have arisen from past events. Now, typically this will be as a result of a contractual agreement. For instance, if I enter into an agreement to purchase goods from someone else in return for money. It might arise for legal obligations. For instance, if I pay a staff member some money, I might have to pay some Class 1 national insurance contributions to the government as a result of that. Or it might be because of a pattern of previous behaviour. So for instance, if I work for a company that always refunds customers who return goods whether or not the goods are damaged in any way. So there might not be a contractual or legal obligation, but past behaviour suggests that we would replace the goods or refund the money. Lastly, it should be it should result in an outflow from the entity of resources embodying economic benefits. Here we're talking about something of value is leaving the business, whether that's cash or a different form of asset, whether it's the provision of services, or perhaps we're converting an obligation into equity in the company or shares in the company, or another type of liability. Now, equity is the easiest of the elements to define. It is simply the residual interest in the assets of the entity after deducting all of its liabilities. And what does that mean? It's simply the accounting equation. Assets less liabilities equals equity. Typically in companies, we see equity split into a number of different categories, such as share capital, retained earnings, and other reserves such as a revaluation reserve, for example. Lastly, we'll start looking at the elements that relate to performance, and we'll start by looking at income. Now, the definition of income is rather tricky. It is: income is increases in economic benefits during the accounting period in the form of inflows or enhancement of assets or decreases of liabilities that result in increases in equity other than those relating to contributions from equity participants. It's quite a difficult definition to remember, so let's try and think what it actually means. Well, when a company's assets have increased or its liabilities have fallen, and that change has resulted not from new investments from shareholders or by taking on new liabilities such as loans or trade creditors, then we must have received income. Now, income would include such things as sales revenue, bank interest received, rents received, gains on disposal of non-current assets. The final thing that I would say about income is that it is going to eventually contribute towards equity, and it does that by increasing retained earnings or profits. Lastly, we'll look at expenses, and like income, this has quite a complicated definition. Expenses are decreases in economic benefits during the accounting period in the form of outflows or depletions of assets, or incurrences of liabilities that result in decreases in equity other than those relating to distributions to equity participants. So, when we see a company's assets fall or liabilities increase, and that fall or increase is not due to returns of funds to shareholders, such as a payment of dividends, or by the taking on of new liabilities, such as loans, we must have incurred an expense. So, expenses, the term would include things such as costs of sales, selling expenses, administrative expenses, finance costs, losses of disposal of non-current assets. But an expense would also affect our equity, specifically the retained earnings, as expenses would have an effect on a company's profits for the year. So now we've defined our 5 different elements, we must determine when they should appear in a set of accounts. Well, they do so when they meet 3 conditions. First of all, the transaction must meet the definition of an element, which is of course self-evident. We would only record an asset if it met the definition of an asset. Secondly, it's probable that any future economic benefits associated with the item will flow to or from the entity. So for example, if I wanted to record a property as an asset in a set of accounts, I would look at what the future benefits of that property were and whether or not they would flow to the company. So if I expected to receive rent from the property from tenants, and that was going to be paid to the company, that would meet that test. Finally, the item has to have a cost or a value that can be measured with reliability. In the majority of cases, this is fairly straightforward, but for instance, let's think about an asset that is not normally recorded in a set of accounts, such as customer loyalty. It would be very difficult to determine how much that customer loyalty actually cost us to acquire. So we can't measure it with reliability, so it wouldn't be included as an asset. Now, when we're looking at our accounts, there are a variety of different ways in which we can measure the value that should be recorded in a set of financial statements. The conceptual framework identified quite a number of these. Now, these are simply possible ways. We're not automatically talking about ways that are allowed or permitted. The first is historic cost, where we would record the amount at the time of the transaction. So if I have spent £50,000 on buying some goods for resale, I would record those goods at their value or at their cost of £50,000. I could also record them at their current cost. So again, we go back and say, if I have purchased goods for resale of £50,000, but it would cost me £60,000 in today's money to purchase those goods, I could record them at £60,000. A third method would be realizable value. This would be to record the amounts at the saleable value, or the amount required to settle the liability now. So, for example, I might have recorded a liability at £10,000, but if I went to the lender and said, how much would you accept if I paid now, we might result in in recording a different figure. A final method would be to record present value. So this is when we look at the future cash flows associated with, say, with a liability or an asset, and we discount those future cash flows and put them in today's terms. So how do we use these measurement bases in practice? Well, the vast majority of transactions are in fact recorded at historic cost. But there are odd occasions where we might use a different measurement basis. So for example, non-current assets are sometimes revalued and shown at their fair value. Likewise, inventories, these should be shown at the lower of cost and net realizable value. So typically they'll be shown at cost, but there might be odd items included in the inventory figure that are shown at a lower figure, this net realizable value. A further example would be defined benefit pension liabilities, as these are shown in the statement of financial position at their present value of the expected future cash flows to the members of the scheme. So we do see something of a mixture in practice, but by and large most things are measured at historic cost.